The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good morning, folks. We're going to have Ed Carlson from the Market Technicians Association out of Seattle as our guest. He's the gentleman who wrote the book by George Lindsay. He's going to come on at 9:30 and talk to us about the three peaks in a domed house. He is the gentleman that I get my advanced decline line from each day, and we'll post that in just a minute. But it'll be interesting to listen to what he says. He's a really consummate technician. He's incredibly good at what he does, and being a CMT, adds to his viability. The first chart that I posted into Tiger TV today is the chart of silver, folks. We are at the proverbial moment of truth in the silver. We're setting right at the 786 retracement of the low we made 3.5 weeks ago. We're with just, the 786 of that number, which comes in at 1650. 1640 is a 61% retracement going back to way back in April. You can see both of those numbers highlighted by the circles that are there. So we're at a pretty significant spot here for silver. It must hold above the 1640 or it's not going to be any good. That same number we'd be looking at in gold would be around the 1180 level. But silver is just set up perfectly. You just can't look at it too much. Now, when we were on the show yesterday, a couple things were happening. One of the main things that we were watching was the Treasury bond market, and I wanted to post that up here to show you folks because we're having our first ABCD correction since this whole big thing happened. It's not, it's been straight down basically, but this is the first ABCD correction. The market we measured takes us to 151.04. Yeah, 151.06, and we've been down to 151.01 right now. But this is the area where we are taking off the short positions in the bonds that we were looking at last week on Friday. When they got up to 157.05, they went to 13, and they've dropped a great deal. In fact, they've dropped more than I ever thought they would in a matter of a few weeks, let alone in 4 or 5 days. That's a very, very bearish, very, very bearish picture in the Treasury bonds as I see it. Now, if we take a look at the Treasury notes, you're going to see something that's even more startling because we're going to have rates are going higher, folks. I don't know if this is why these markets are so jumpy or not, but you can see the 10-year Treasury notes look like they're going a lot lower. They're already yielding 2.225, I believe, and that is better yield than they have in both Italy and in Spain. I mean, give me a break, folks. What's wrong with this picture? What is the old cowboy not seeing? Are the fundamentals different this time? I mean, this is real money, and our bonds are, much higher graded. Plus, they are, more heavily traded. So I don't understand the process, but I'll go along with what they're saying. But it doesn't make any sense to me at all. But interest rates are coming higher. I don't think there's any question about that. It shouldn't be a surprise when they do. They may or may not be a surprise to the stock market. Who knows? It keeps going up no matter what happens. In that regard, I wanted to bring up something that I think is important because we mentioned this on the show yesterday, and it happened again right after I got off the air. We had gone right down to the ABCD pattern in the S&P down at that 2096 level. And as you can see, this is the New York Stock Exchange Index. Pay really close attention to this, folks, because I think this is the key to what's happening. You can see 3 days in a row where we've had the same bottom right exactly at the 786 in the New York Stock Exchange. Now, keep in mind now that the NASDAQ has made a newer high than we made on the 20th of May. It is also, the S&P has gone up above the highs that we made on the 26th by a considerable amount. They're way above the 786%. And also, see the S&P and also the Dow Jones and what's the other one? And the NASDAQ, S&P, Dow Jones, and NASDAQ. All of those have gone above those numbers. Now, the Dow has only gotten back to just a little above the 61% retracement of this move, but the New York Stock Exchange Index has barely moved at all. Now, it's going to be higher today because we're opening here in about 20 minutes and the market's up, so there's going to be a lot of buying, but you want to watch to see how much power this has here, because if we, for some strange reason, and this is a relatively weird astro date, and I say weird astro date because it's got a lot of nuts and bolts and molasses and sugar and everything mixed up together, as Norman Winsky described it. And so it could really be a, very, very volatile day. We're already seeing that in a lot of things already. However, let's go on to the next case here. If this market is really strong today, it's going to come out of the box and just keep blasting forward. If we just barely get above the highs in the New York Stock Exchange Index that we made yesterday and don't take out the highs from where we were back on the 26th of May, that is set up for a real negative scenario. And if we go below the lows that we made earlier this week on the 27th and late last week, 27th and 28th, that is going to be incredibly bearish because you had no rally, and you'll be breaking below the 786 retracement. The advanced decline line, which we've mentioned, just about every time I come on the show, I like to show that because it gives a pretty good idea where the buying and selling is. And you can see over the last, this is up to date as of yesterday, and we will put this in here and let you folks take a look at it. You'll see that the advanced decline line is still turning down. And maybe this is the thing that makes it turn around and go up and pop through. But you got to be bullish as long as you stay above those lows that we made the last day or two. That's 2096, I believe, or 2092 in the S&P, and I think 4484 in the NASDAQ, and the Dow at around 17,950, I think, is the number. But just remember the lows of late last week. If we take those lows out, this is not a good thing, especially with the advanced decline line, turning down. Maybe this will turn up. Who knows? I'm not sure. We'll have to wait and see. If you have any questions, it's 877-927-6648, and we'll be happy to answer those for you. Now, we've had a great deal of activity here in the currencies. I want to bring up the euro here first because this is going to be one that's going to be real interesting to watch here. We've had, whoops, that's the wrong one. Just a second. Where are you, euro? Here we are. Just a second. We had a big number coming up in here. I'm just pull it up here so we can see it. There we go. I won't be able to see this 618 going back till the middle of May, because that's what we're coming up to right now. We have a 61% retracement coming in at the 112.08 level. And that will tell us that we're probably going to be running into a little bit of resistance at that point. Now, today's low was exactly a 38% retracement to the exact tick at 1.1076 was the exact 382 retracement of the low that we made on June the 1st. That's when we had the first run up. Now, the 61% retracement coming off of the high from May the 17th, that comes in at 112.18. And these numbers are really, they're really pretty much spot on. Now, if it does that, it's going to take out the highs of early today and also of yesterday, and it'll look like it's going to go straight to the moon, and it certainly could, but that's going to be some resistance area to watch here in the euro. That's at 112.18. We're trading at 111.66 right now, so we're about 50 pips away, and we've just rallied 100 pips in the last 15 or 20 minutes. It's just been, basically a straight up move, and there's nothing else you can do about that. When it goes straight up, it goes straight up. We'll just have to wait and see how it goes. We will be able to see how the New York Stock Exchange opens today because we'll be on at the half hour, and we'll be able to watch it without too much trouble. And that's the other one we wanted to watch here real closely. Oh, we want to take a look here at the NASDAQ, because the NASDAQ has taken out the highs of the last several days. We had a big sell-off in the NASDAQ yesterday. It stopped exactly last night, late afternoon, exactly at the 61% retracement. and proceeded to blast off higher and take us up above the 786 retracement of the high we made back on the 28th. We could very easily make new highs in the NASDAQ today, folks. It's not very far away. If we matched what we did yesterday, we could easily take that out. And as long as this market does not take out those lows that we made on last Wednesday, Thursday, or let's say that again, Thursday, Friday, and Monday, this thing has a real chance of making new highs. Now, whether it's going to go straight up or not, I don't know. This is like I mentioned before, it's an astro date, but it's a weird one because it's got a lot of crazy things in it that I don't consider. But when you look at it statistically, you see a lot of turns coming around that time. And of course, we're still in the Mercury retrograde, and we're 1 day off of the full moon. So maybe that has some effect with that. That we'll have to wait and see if that's going to be the case. But that's neither here nor there. Okay, now the next one we want to do is we would like to take a look at, let me see, the next one we want to watch is, okay, we'll take a look at crude oil here. I hope I can get this put up. Yeah, let's take a look at it because we're interested into a situation here where we've got to make one little change here, and then I will be right with you here. Hold on a second here, and we'll be right with you. Hold on. There we go. Give me a second here to get this crude oil up, and we'll see what's happened. Yesterday in crude oil, we came within a heartbeat of a double top. We made a butterfly pattern up at that area. We broke about $2 a barrel early this morning. We've now rallied back a barrel. We stopped exactly at the 61%. Let's just put both of these in together because this is really an amazing statistic here. You can see that the market stopped perfectly at the 61% retracement on the way up and 786 on the way down, and just absolutely perfectly. And that gives it a price objective of 61.20, and so that's another one that looks real. In fact, we're almost there as we're speaking right now. We'll just pull this up and you'll be able to see it, that we could easily get up there to that level again. So we're jumping around $1 a barrel in crude oil like, nothing is happening, but that's what's happening. It is jumping around quite a bit. So crude is, got a chance here to bust through to new highs if we get above the 161.50 level. But if failing that, it looks like we have made some type of a pretty good top. The gasoline futures and the heating oil futures were far weaker. They broke quite a bit, and they haven't rallied nearly as much as the crude oil. Now, crude oil is still up on the still down on the day a little bit, as is the gasoline and stuff. But that can change very very quickly, as we all know. So we got the opening coming up in about 20 minutes. That'll be interesting. We've got a break coming up, and we should open substantially higher in stocks. Looks like the Dow will be about 80 to 100 higher, so we'll see what happens.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I've posted the chart of July wheat into the den today because we are in the zone of the full moon, which wheat has a tendency to turn on quite a bit. And so what we're looking at here is wheat, bottomed right at the 786 level down there at 474 a bushel. We have since rallied 50 cents in the middle of a terrible bear market. I mean, the supply of wheat is overabundant. As Rich Anderson mentioned, cash wheat is 50 cents. Our wheat. Let's try it again, Larry. The worldwide wheat is trading for 50 cents a bushel under what we're trading at. So someone must really want our wheat very, very badly. Well, we've rallied up as of last night. We went up to 517. That was the 786 retracement of the move from the low to the high, from the high to the low. And since we're right over this lunar aspect, this full moon, this appears to be a sell signal at this 786 level, risking about 6 or 7 cents to above 523 to put a stop in if you're wrong. So if that's the case of what wheat is doing, but it hit the patterns. That's really really all it is. Now the next one we want to take a look at is the we want to take a look here at the price of soybeans. We were looking at 903. We got down to 896. We rallied up to 918 last night. We're now trading at around 914. Keep an eye on this, folks. We're going to be watching this every day, because what I'd like to see over the next few days here is a small Gartly pattern on a half-hour chart, maybe pulling us back down to the 906 level. And if we get that, that's going to be a really low-risk entry level into the soybean market. If you're still in this, it'd be a good place to possibly add on. It's made its first profit objective without too much trouble, but it's looking a little better than it was late last week. So we'll have to wait and see if that's going to hold. I've noticed that the Treasury bonds are extending their move to the downside. That's probably due to the fact that we're taking out the lows that we made several months ago. I posted that in earlier in the Tiger Room, but what was happening with the notes, breaking down badly. They've got another couple points to go. That's going to take the yield up near 2.5. And this is going to be, interest rates are higher, folks. I don't care what the Fed's telling you, they're higher. The real market are these notes and bonds, because these are huge markets, and it's making a big dent in the side. In fact, I cannot remember. And I asked several of my friends, the last time we've seen a 6-point drop in bonds and stocks go higher. They usually run in tandem, but boy, this time they certainly aren't. We'll have to wait and see what's going on. We'll have Ed Carlson on at the break, and then we'll keep an eye on what this New York Stock Exchange Index is doing, because that's the key. If we go below that low of the last few days, it's sayonara, goodbye. Hasta la vista, hasta luego, wherever you want to say. It's going to be pretty bad if we get below those, because that's the last bastion of support. And we've had this days where we've had the advanced decline line keeps dropping, and that's not a good sign either. At least it used to be in history. It was never a good sign. Whether that's going to be the case or not, now we'll have to wait and see if that's the case. Okay, we've got a couple minutes here to the break, and if you have any questions, 877-927-6648. One of the questions that someone asked me was about Apple, and folks, I tell you, that stock is just call the Apple store and get on their recorded message, and you tell me if you wouldn't short this stock. It's unless you're a real techie, you're in big trouble. That's the way it looks like to me. So we'll have to wait and see if that's going to be the case. But it's going to be really interesting, and so we'll see what's happening. We had a butterfly bottom down in the corn, down at the 365 level, and we could, we rallied 10, 11 cents off the bottom, which is normal for a rally. But this next little pullback is going to be the one that see what's going to be happening. That's the real key to be watching. Let me see. We talked about the advanced decline line. The key chart today, folks, that I'm talking about is that New York Stock Exchange Index chart that shows the 3 days. Fact is, I'm going to post that again because it's so very, very important. And just make sure that you don't be long stocks if we get below this level here, because where we made back on the last few days, because that was really strong support. The market hasn't rallied very much. If you look at what the overall market has done compared to what they're telling you in the S&P and the NASDAQ and the Dow, that's 531 stocks. The other 6,500 are not doing this, so let's pay attention. Okay, we're going to take a break here. We'll have Ed Carlson, Market Technicians Association, back in a few minutes.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization optimization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. It's hard to believe that it's been almost 2 years since Andy Hecht started his newsletter, the Technomental Commodity Report. In that time, he's delivered many winning trades for his subscribers. To commemorate Andy's 100th weekly issue of his newsletter, we're rolling back the monthly price to the introductory rate of only $59. This is a one-of-a-kind special that is only around until Thursday of this week, which is the day of his 100th issue. By taking advantage of this 100th issue special, you can lock in Andy's original introductory rate for as long as you remain a subscriber. That's an incredible 25% savings every month off the retail price. Andy delivers in-depth analysis of the commodity market every Thursday in each issue of the Technomental Commodity Report, while providing specific trading recommendations on ETFs and option positions within the commodity market. Don't miss out on this special, as there are only hours remaining. Sign up for the Technomental Commodity Report right now at the front page of TFNN.com.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they have just released the second running of their 5-year Market Safe Futures Economy CD. This is a CD that could really deliver, but you only have until June 11th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all of the upside at maturity. And should they lose, no worries. There's zero downside risk here, as you get back 100% of your deposited principal. Don't miss out. The June 11th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Back on the air here. With all this volatility, I almost forgot that we have a half of the show left, and I think we've got Ed Carlson from the Seattle Technicians Market Technicians Association on the air. Are you there, Ed?
Hey, Larry. Good morning.
Good morning to you. Thanks for getting up with the chickens today. I appreciate it because it's 6:30 out there, right?
It's a little early. Yeah, I'm trying to get my eyes open, working on my first cup of coffee.
Well, that's good. Listen, my friend, we have a situation going now where I've got your chart up for the simplification of all long-term cycles. You want 1798. That was 3 years after I was born. I'm glad you brought that up. Hey, listen, do you want to discuss this, and we'll go through these cycles, and then we'll want to give a chance to give you a little promotion about your book with George Lindsay, because he did such a fabulous job with technical stuff long before people were looking at it. So fire away, Ed. Go ahead.
Well, so you're just going to throw me right in the deep end, huh? All right.
I have to.
You have to. Okay.
Yes.
Well, all right. So you see the simplification of all long cycles. This is a template Lindsay created. It describes it's his description of the market going back to obviously 1798, and it comes in roughly 20-year, but the long cycle lasts approximately 20 years. Now, at the risk of bearing everyone with too much information, but it's nice that you're able to see it as well as hear me speak. Every one of these cycles, say ABC is a cycle, CD is a cycle. These are called the basic cycles. That's what Lindsay referred to them. And the long cycle itself, which obviously is A through M, is divided into two multiple cycles. That's the first one goes from A to E, and the second one goes from E to M. The distance from A to E is roughly 7 years, and from E to J or E to H or J is roughly 8 years. So obviously the distance from A to H or J is 15 years. You notice there between K and L, that is a three peaks and domed house formation for those of you that are familiar with it. So we always, Lindsay said to always expect a three peaks and domed house there at the end, but it shows up at other places. I've found it consistently, it shows up between C and D as well. But that's just a little background information before we get to the next chart.
Now, Ed, I want to ask you a question here.
Oh, sure.
As I recall reading Lindsay's stuff, and Arch Crawford happened to be a friend of his because Arch was in New York at the same time Lindsay was there and Arch was at Merrill Lynch. But his work was very, very accurate, as I understand it. It was within a day or two when he made a forecast. And he was quite was very, very good at it. And he was a friend of Louis Rukeyser, too, wasn't he?
Well, okay. First part, very accurate, yes, or it could be. It wasn't always. I mean, speaking of Rukeyser, George was on Rukeyser's program in 1981 and 83, and in 81, Rukeyser asked him, when's the end of this bear market? And Lindsay made a forecast right then on television, and he was within, I think, 2 weeks of hitting the low. And that was a year in advance. Almost a year in advance. So
that's
it gives
spot
you an
on.
idea as to its accuracy, yeah. As far as being a friend of Rukeyser, the story I got was actually Rukeyser was friends with Yale Hirsch of Stock Traders Almanac, and Lindsay and Hirsch were friends, and that's how that two of them, Rukeyser and Lindsay, hooked up.
Okay. I just wanted to clarify that.
Okay, you want to go to that next chart?
Yes, sir. I'll put it up right now. Get it right up. This is the one that I really enjoyed, this chart. Oh, just give me a second here if I can get it.
All right.
Oh, I know what I'm doing wrong. I'm hitting the wrong toggle button. There we go. This is the one that has the chart going from 1999 to where we are right now.
Right. This is the Dow, and this is at least my interpretation of the long cycle. So you can see the beginning of a new long cycle happened in 2002 at that low. It just, well, actually, just give people some reference here. Have long cycles now in the 20th century of 1921 to 1942. So that was over the period of boom and big crash and depression.
Mm-hmm.
Then we had 1942 to 1962, which was almost straight up. Then 62 82, which was another big sideways move. You know, we had a lot of cyclical bull and bear markets within that long cycle, but overall, we ended about the same place we started. Mm-hmm. Then from 82 to 2002 was another big bull. I call these secular bull cycles and secular bear cycles. Mm-hmm. And if this alternating nature continues, we should be now, since 2002, in a secular bear cycle. That doesn't mean we don't have big bull markets within the cycle. Mm-hmm. That what it tells us is, if it's correct, is that we should end this long cycle roughly 2020, not too far from where we started it in 2002.
Mm-hmm.
Okay.
Well, this will be real interesting. The chart sure technically looks just as lovely as you could possibly get it, seeing these formations on the chart. I really enjoy watching these.
Okay. Well, and I think people will find it interesting. The reason I spent a moment with that first chart, going a little deeper than most might want, is because look at what we've got. Okay, A, Point A was in 2002. Point E, as I've labeled it, is 09. The difference is 7 years. Just like Lindsay said, the difference between A and E is 7 years.
Mm-hmm.
Now, the difference between the time span between E and H or J is 8 years. So, here, 2017, yeah, that's right. So, J should be coming up, actually, to be a little more precise, very late in 2017 or most of 2018 is the time frame for that. Now, we know that because here's another concept. Lindsay had what he called the long-term intervals. This was the first step in trying to forecast a market high or market low. So let's start with H here. To try and forecast H, we count 15 years, 15 years, and 11 months. We have an 11-month interval. We count from an important low, and it's within that 11-month time period that we expect to find an important high. So we should be seeing an important high anytime between last October and this September. Okay. Now that's a pretty wide time frame, I know, but we can narrow that down with other things, which I don't think we're going to have the time to get into today. Lindsay's other models. I want to kind of show the broad strokes here that are fairly simple to understand via, media that we're on. Okay, so then if we count the next 12-year interval, which counts to a low, 12 years, 2 months to 12 years, 8 months, you would count from February of 2004. And that gives us a time frame middle, actually kind of the dead center of 2016. So we would expect a market top, a bull market top, anytime now, be followed by a bear market down to point I sometime next year. Well, that matches up with another one of Lindsay's rules of thumb, which is he said just figure 2 years up followed by 1 year down. I mean that's rough, obviously, but it's a place to start. Okay, just a rule of thumb, and that's exactly what we get. Now, if we bottom out in 2016 and we assume 2 years up, well, that takes us out to 2018, which is where our 15-year interval told us point J should be anyway. It all just kind of works together. It's pretty sweet.
Okay, now we've got one more chart to go, and that's the one with the 3 peaks and the domed house. Do you want to kind of walk us through that one? Because it points to look like we're pretty spot on, ready to head down if the market ever gets the memo.
Right. Sure. Okay. So, for those that aren't, how much time do we have, Larry? Are we talking
as long as
here,
you like, my friend, as long as you like.
Wow.
Having someone your quality on, you just take as long as you like. We're going to go, we have at least another 15 minutes, so keep going as long as you feel that you can give us good information. This is what we like to hear.
All right. Well, for those that never heard of it, Lindsay created a model called the 3 peaks and domed house. Actually, I've found awful lot of people have heard of this model, but very few people know the creator. Well, now you know. The 3 peaks and domed house obviously is made up of 2 formations. There are 3 peaks. Lindsay wrote that there should be 3 peaks no less than 6, no more than 10 months apart between peaks 1 and 3. My own work has found that 4 to 10 month interval is probably better. You can see I've labeled December 31st, 2013 as peak 1, July 14 as peak 2, and September 14 as peak 3. Okay? That is followed by what's called the separating decline. That is a decline to a level which is lower than either the reaction following peak 1 or peak 2. We got that. That was an important requirement. I also think it's interesting, if you look way over at the left chart in November, you can see what Lindsay called a minor formation, what most of us think of as a fractal of an entire 3 peaks domed house. You can see how you had your 3 peaks, you ran up into the domed house, which actually created the major patterns peak 1. That the fact that you had a smaller 3 peaks embedded in a regular 3 peaks told us that sell-off following peak 1 was going to be deep. Anytime you get a 3 peaks domed house, you get a big sell-off. Okay, so separating decline came to an end in October last year, and the domed house began. Well, you can see the big move up from the low in October to the high in December. What's the good word for that? Parabolic.
Yep,
and that's
definitely parabolic. Yep.
And that's exactly how Lindsay would have described what he refers to as the first floor wall. It has to be an almost straight up formation. And then the period following December 26th is a 5-wave reversal. See, I've got them labeled there, and that's Lindsay's definition for what he calls the first floor roof, okay, of the domed house. Now, you do see a big pullback prior to December, and that's very common in these formations, and basically you just have to kind of wait it out and figure out where to count from. But once you've got the 5-wave reversal, you know you're now beginning the second floor wall, which began on February 2nd, and again, you get a straight-up move. My own work has found that this time frame has never been any less than 28 days, and sure enough, that's exactly how long this one lasted. Also, my work, not Lindsay's, but my own, has found that at this point in time, there's always been another 5-wave reversal, or a 3 or 5-wave reversal, excuse me. And you can see we got that with those small Roman numbers I've got in there. Now looking for the top of the cupola, which would be the top of the bull market. And it's from here, once we print that high, then Lindsay said that there's never been an exception to the rule that the entire advance seen during the domed house, never been a time that wasn't completely surrendered after one of these formations. So then we engaged in a series of exercises trying to figure out where the top is going to be. Now, I'll just tell you, trying to pinpoint a top to these single date forecasts that made Lindsay so famous, using a 3-piece and domed house, it's not really, this formation is not that accurate. You really need to use Lindsay's other models in order to come up with something extremely accurate. I've come up with a forecast date of June 5th through 9th. That's actually this Friday and the following Monday. But you look at what we've got here, and for example, at the very far right, you see 2 vertical lines drawn off of a horizontal line. That is what Lindsay's 107-day interval. You take a count of anywhere from 102 to 112 days, and that often will give you a high. That matches the forecast from the middle sections, counts of the middle sections, which point to this Friday and the following Monday. So that's interesting. However, I just noticed this other interval a couple days ago of 106 days, drawn from February 2nd up to the most recent high a couple weeks ago in May, 106 days to that date. And I'm looking at it and thinking, my gosh, is that forming a head and shoulders? That would be the perfect ending. It might be, Larry, that the top of the bull market's already behind us. And the fact that the middle sections don't count until this Friday, be off by a couple weeks. That is the extreme, but we've seen it before, and that shouldn't be a problem. So I think that the message here is be on your toes and don't fall asleep, because this thing is just about to wrap up.
Well, that's what we're looking for, so we'll have a good idea of this. Now, Ed, if the folks want to get, we're going to have a break here in just a second, but here, we're going to have stay with us till after the break so we can get some information from you about how to be reached, okay?
All right.
Thank you.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Okay, we're back, and we've got Ed Carlson on talking to us about George Lindsay, Three Peaks in a Domed House. Ed, I know you wrote a great book because I've got it and I look at it on George Lindsay. If the folks want to get in touch with you about your newsletter and the book and stuff, what's the best way for them to reach you?
Oh, sure. SeattleTechnicalAdvisors.com.
Well, that's a mouthful.
Isn't that? I should have made it Seattle TA. That would have been a lot more helpful. But I didn't, and now I'm stuck with it. SeattleTechnicalAdvisors.com. You can Google that, or you can do a search for me, Ed Carlson, and usually either one of us will show up on your search engine. We offer a trial subscription so people can see just what the work that I'm doing, and if you're interested in the books or DVDs, there's a page at the website for that.
That's good. Well, I happen to have seen it, and it is really very good information. Well, what we'll do is we'll have you on maybe in maybe 3 or 4 more weeks, and if you need to talk to us sooner, you can certainly just drop me an email. And I appreciate you sending me the advanced decline line each day because I share it with our folks here at Tiger TV. So I want to thank you very much for that and being our guest today. So hopefully we'll see you in a few weeks. Okay?
Well, thank you, Larry. Thank you,
Ed. Have a nice day, and hope it's not raining today out there in Seattle.
It is.
Well, it is in Philadelphia, too. So we'll talk to you later, my friend.
Bye, Larry.
Okay. Okay, folks, we've been trading here for about, how long have we been trading now? Let's just go here, and we'll just pull up the New York Stock Exchange Index chart and just see what's happened to it in this first hour. We'll see how much it exploded to the upside. Wow, this looks awfully not very good, in my opinion, but what do I know? You would think this thing would be going nuts. If this market makes new lows from here, it's really got big problems, folks. It's still real early in the morning, I guess, because we've only been trading about 20 minutes. But as you can see, the first part of the day, we have not even taken out the highs of yesterday in the New York Stock Exchange Index as of yet. And we should have done that, I would think, in the first few prints of this, and that's not been the case. So just remember, folks, if we go below the lows we made on Thursday and Friday and early this week, it's going to be really nasty, in my humble opinion. So live every day in an attitude of gratitude, and may God bless.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.